Good morning, guys. How we doing? My name is Julian Williams. Happy Monday. Hope you guys are having a blessed Monday so far. I get the pleasure of hosting trading experts, Kathy and Boris from BK Traders. We come on every Monday, every Friday. Mondays obviously talk fundamentals. We talk news. We look at the charts and talk a little bit of psychology. So, guys, how we doing this morning?
We are doing great. Monday's always a good day to be talking, especially since we have so much going on.
Hey! How are you? I'm just working on Twitter Live because Twitter Spaces because we're trying to get that going on the same time, same platform with everybody. Hi, it's a topsy-turvy Monday. Should we say it's a slippery Monday? It's basically a glow slick. We're doing really, really well, and then OPEC decided to just dump a bunch of oil right on the highway and put a crash in front of the markets. The markets clearly don't like it. NASDAQ, Dow is at lows of the day. I think NAS is at lows of the day too. Let me see. No, Dow is at mid and NAS is at lows of the day. So yeah, I mean nobody likes this news because I was reading over the weekend actually. Really, when you talk inflation, everything else is a side note to oil. Like oil pretty much is like 90% of all inflation when you strip out all the base. Because even if you're talking about products, the products are going up because the cost of transportation goes up into the cost of products and services. So, the fact that we're above, we talked about this, right? We talked about that it couldn't stay below 65, that it was going to bounce up. We just didn't, anticipate it was going to bounce like a beach ball underwater.
Well, I think it tells us that the comfort level of OPEC nations, where they want to see this, is 80. On Friday when we spoke, Julian, said what is the point that oil is kind of equilibrium, and we said somewhere between 60 and 80, and clearly OPEC nations are driving to 80. Now there's a couple of motivations for this. Aside from them wanting to reap in even more profits, they probably expect demand to slow. And they want to, offset that with higher prices. And I think that, with this move, as Boris pointed out, the most important takeaway from this rise in oil prices is its implication on monetary policy around the world. Because we have the Federal Reserve, we have the ECB, they're obsessed with inflation. Everyone felt really good that inflationary pressures are beginning to ease. And, oil was below $70 a barrel. We all felt like we were headed in the right direction. Then boom, OPEC does this. And inflation is back, is back to making people nervous and back to making central bankers nervous. And if 80 becomes now the bottom, and we look at, we're thinking, okay, maybe we'll get back to 60, but now maybe we might get back to 90, 100. That is going to, if that happens, that's going to get central bankers to remain vigilant with rate hikes. And that's the main takeaway.
90, 100 is a disaster scenario. Any way you look at it, in the current environment, that's a disaster scenario because what that does is we really haven't wrung out all of the inflationary pressures out of the economy just yet. We're just coming down. And, what you're going, that's literally like the rebirth of the 1970s stagflation. I'm old enough to actually remember that, where you basically have higher unemployment and higher inflation as cost of goods goes up. Both, in basic economics, the supply curve goes up, demand goes down. And that when you take away supply, you're actually raising prices and destroying them, destroying production. It's just a very, very negative situation. So hopefully that's not going to happen. We'll have to see. It's really,
you guys can answer this question, kind of take a turn on it. Does this have any effect on, the Bitcoins and the golds of the world, because of the uncertainty, as you had said, Kathy? Do you feel like people start pushing this up? I mean, I'm watching gold this morning and it's rallying, now it's starting to base a bit, but you think that has something to do with it?
Well, absolutely. Because, we talked about how one of the most important things to realize is that gold is an inflation hedge. And, gold is not up a lot today, Julian. It's, up less than 1%. But yes, sure. On Friday, it looked like, perhaps we're, hitting a top, we're pulling back and we may start moving down towards 1950. But today, right now, we're above, Friday's open. And if we close at current levels, particularly if we close gold at the highs, which would be around 1970, I would say that, there's a good chance, first of all, we're, going to retest 2000. And, that's really because we've got this inflation and oil story. Now, the real question to ask is, is this really the main problem? Is, oil at 80 going to bring inflation back and offset, all of the slower growth that we're seeing? I think the answer is no. I think that this is just a temporary blip. A lot of times we get these OPEC production changes and we get these impact on commodity prices. They tend to be short-lived, which is why they oftentimes feel like they need to keep on doing it because they're moving against, economic forces. So because of that, I think, we're not necessarily going to, it's not going to be the scare that everyone is afraid of.
Yeah, let's just hope that, as always, OPEC's word is not its bond, and that they're going to cheat. Because really, whenever they do these voluntary quotas, always somebody within OPEC begins to cheat because, they were selling at 60, now it's at 80. So it's very tempting to just overproduce, which means they're going to bring it down to 70. Let's just hope that really happens and they don't have any internal discipline. But yeah, I mean, geopolitically, this was a tough move. I got to tell you, I'm wondering, to me, aside from the economic issue, is the geopolitical implications of all of this. This was a big slap in the face, especially from Saudi Arabia, to which we give, $200 billion worth of arms and goods. At this point, they're really the problem, in my opinion. They've become like the mini Russia from a geopolitical point of view, like our enemy number two. Almost as bad. In fact, I could make the argument they are literally as bad as Iran. And it's going to be interesting to see how this administration and many administrations going forward are going to, create their foreign policy. Because, Saudi Arabia is still the swing producer in the world for oil, but we bought their friendship with lots and lots of demand and armaments, and they're basically biting the hand that feeds them. So it's going to be really good to see from a geopolitical point of view, because if that becomes if we start treating Saudis like the way we treat the Iranians, that's going to create a much more different world structure than before. It's all the more reason why I guess we have to go to the electricity standard. But it's a question of, how soon and how far.
Typically we don't give too much credit to these, OPEC changes. But I think at this interesting juncture of, inflation as well as Fed policy and geopolitics, I think that, it's definitely worth watching, and its ability to create a durable move in oil is, probably the most important thing for the Fed going into May.
Yeah. It's interesting because we talked about it over, last week. We said, if one of these other banks, small or regional, kind of, have another, the other shoe drop, so to speak, then that might be why gold takes another rally. Now we're talking about it going up 2,000 because oil's making this, crazy move here. So it's very interesting to look at. But what does it mean for oil, futures and stuff like that in weeks to come? What are we thinking? Do you think we're going to start pushing our highs, getting up into the high 80s, 90s? Or we think that's going to take a little bit more time?
Yeah, I think the high 80s and 90s becomes only becomes a self-fulfilling prophecy if like sort of, I don't know, some major oil supplier goes offline, or if Russia does something that could be construed as even more aggressive than what it's been doing, or if Saudis just decide they're not going to export anything to us at all. I don't know. From a pure supply demand picture, as we talked about, the market is pretty much in balance at around that 70-80 level. So what will take it above 80 is some unexpected, unknown event that hopefully won't happen. But I don't think right.
I feel like on a technical perspective, oil is one of those instruments where, either A, the gap tends to be filled, less frequently, or even if the gap, which is the one that we had on Sunday night, is filled, it doesn't prevent the overall trend from being established. So, with oil right now, we're above 80, and we so far, today we haven't seen any pullback from that at all. We've just pretty much stayed pretty stationary. So to me, it tells me that yes, maybe it'll pull back a little bit, but from a technical perspective, I think it wants to get up to 84, which is not that far from here, and that's really the next major resistance level for oil. Now, if we do fill, I think at most we'll see a move down to 78 in oil, which is right above the 100-day simple moving average in the contract. So I think if you look at the oil chart carefully, there was a consolidation, kind of triangle pattern forming, and we've now had the breakout. It could test the former breakout point, but it could potentially hold in a technical perspective.
Okay.
We can start sharing charts if you want, though. I'm happy to.
I'm happy to share. Let me share my oil chart real quick, just to talk about this. And for those of you who are on Twitter Spaces, the YouTube link that I included is where you can go to watch our charts, and I'll post that again in a second. Do you see my oil chart, Julian? Let me know whether that's the case.
Let me see here. Okay,
we see it now.
Yep.
Okay, great. So I'm just posting the YouTube link so everyone can look at my chart. All right, so here, this is the gap that I'm talking about, and basically, it took us above the 100 SMA. Resistance is up at the 200 SMA in oil here, and if you look at how we were trading before, we basically have consolidation pattern, a triangle itching for a breakout, and we've finally broken out to the upside. It could come back and test. Where's my highlighter? I'll just use this. It could come back and test this point over here, right above the 100 SMA at around 78. But for the most part, I think it could hold. If we go back and look at some of these gaps. I don't know if we had a recent gap in oil. Like this was a little bit of a gap. It trended lower. Here we have a little bit of a gap. It continued onwards. So oil is one. And here's another gap here. It gapped down and then it just continued. Oil, we often like to say that gaps are filled, but the longer they remain unfilled, the more significant that breakout. And with oil, I feel like, Boris, you can correct me if I'm wrong. I feel like, when the gap happens in oil, it has a lower chance of being filled than some of the other instruments.
Because oil is a sort of a global commodity, and oil is much more a function of runaway gaps than it is of gap fills. I mean, gap fills are a function of just, extreme supply for something like a stock at a particular point, and then there's going to be natural sellers. In oil, which is a physically demanded commodity, if the physicals, which is Saudis and OPEC, the people who actually produce it, constrain supply, there is no reason to fill the gap. That is a runaway gap. That means supply has shifted smaller, demand has had to shift higher. So I said this is going to take a while. It's not until they start cheating that oil is going to go down, which is going to be a long time. So it's very likely it's going to just kind of tread water, and any kind of further saber rattling out of the Middle East is only going to add, to the thing. The irony of the whole thing, I think the ultimate irony of the oil story will be if the Iranians begin we sort of we ease our relationships with Iranians and they start flooding the market with oil. They'll be the swing producer to the downside and bring it down, which would be, completely in a world of Middle East. I guess anything is possible, but it would be ironic if it was the Saudis who raised the price of oil and the Iranians brought it down. We'll have to see. But right now, Kathy's absolutely right. Runaway gaps is much more the norm rather than the exception in oil because it's a truly physical market. It's expressing a truly, physical constraint.
Well, it kind of moves me into my next question. Oil obviously affects other markets and commodities, things like that. So, Boris, if you want to take this one, or Kathy as well, even in the FX market, what is it doing to, the pairs that you guys are looking at?
Well, with FX, I've been all over the CAD trade this morning, and it's a pretty easy setup. Like, let me, with dollar CAD, I want to I'm going to show you the relationship between oil and dollar CAD. So just give me a second to remove all this excess thing I have. So I have the oil right now on my chart, and I'm going to add on the Canadian dollar. I need to invert it so that you can see it more clearly. So you can see the CAD's on top. So just give me 1 second to do that. So we're going to pull this up. We'll just bring up, one of these, and I'm just going to normalize. I'm going to move this to the left, and then, oh, sorry. So now I want to do it. Click on this. Pin it to the left, and then I'm just going to make this regular. Okay, so we're in a daily chart. The candlestick is oil, and the orange line is CAD dollar. So you can see very, very strong, tight relationship where if oil's rising, which is what's doing right now, you can see the line for Canadian dollar is rallying as well. And if oil's falling, you can see the line with the Canadian dollar is falling as well. And if we bring this on to a 1 hour chart, I have no idea why it's not showing this, but here it goes. If you bring this on to a 1 hour chart, you can see that the relationship, even if we go this way, as I'm scanning back, is also very, very strong. Yeah. So we've got a very, very strong relationship between oil and the Canadian dollar. So it was an easy trade. I use Zip, and can you see my other chart? Okay, I think you're not looking. Let me shift my, I'm moving too fast for, okay, so I'm going to remove the oil here. I'm going to add my Zips indicator. I'm going to go back to we're at the 1 hour chart. And so I'm going to make this, I'm going to remove CAD dollar. We're going to put back on dollar CAD. And dollar CAD, actually, no, we're just going to do this. Hold on. Dollar CAD had been in my sell zone, which is below the indicator line, for the past 24 hours or longer. And so when we started the New York session today, one of my first trades was to sell dollar CAD. Last night, when an actual announcement was made, we also went into short dollar CAD because it was, it's a very clean setup. It's a very easy trade to make because oil, as I proved to you in the other chart, has a very strong correlation with CAD. It's a leading indicator for CAD. And that made this trade really easy today.
Okay, nice. Boris, how about yourself? You looking at anything that's affecting, because of the tightening of OPEC? I was reading an article that said, that the energy levels obviously soared. Well, obviously, as you know, that affects, the Dow pretty significantly.
Yeah, I mean, we've been talking about sort of, ad infinitum about the 4,000 level in the S&P. That's holding. S&P is sort of really actually holding bids. So is the Dow. What's really getting shellacked today is NASDAQ. NASDAQ is down, almost a full percent. It's interesting that, I find it interesting that the industrials and sort of like the main economic bellwethers are kind of holding against this higher oil story. Yeah. But clearly, NASDAQ is the most high beta, the most volatile, and it's responding to, to all of these pressures. The other thing that's ironic is actually, and I don't know, Kay, like maybe you have some thoughts on this. I'm surprised, like the 10 years down, the 2 years down, not a lot, but, they're under 2 years under 4. So you would think, like, I'm trying to understand, like inflationary pressures would have driven rates higher, but rates are just a little bit lower. Is it they're worried about the depressionary implications of this? I mean, that's what it seems like. It seems like the markets are pricing in a economic contraction given the pressure of higher oil prices, which is why rates. Yeah.
I think first of all, I think it's important to acknowledge that last night when the announcement was made, yields were up. And actually drove yields up because it did what you initially said, Boris, which is that it made people think that, with commodity prices and oil prices shooting up 5%, this means that the Fed, that this basically guarantees a 1/4 point hike at the next Fed meeting. But, it's at the end of the day, it complicates the job. It doesn't make the Fed's jobs easier. It makes it harder because, we've got a slew of reports this week. ISM manufacturing, ISM services. We actually already had ISM.
And it missed. I mean, it's pretty deep in the red. It's well below the 50. It's at around 44.3. The prices paid were lower. I mean, just like what you're seeing on the manufacturing side is already pretty strong indications of a, if not a contraction, if not a recession, but definitely a contraction in demand.
And that's what turns yields around. Let me, if you look at this, I've got way too many things here. Let me just remove all the indicators. This is yields, and let me get my little arrow going here. And pretty much the 10 o'clock release, which is right around here, ISM that came out weaker, is what turns yields. What basically caused the crash in yields and the reversal in yields.
Right.
And so it's no coincidence. I mean, if you're watching the news flow, this ISM is what made everything turn around and made everyone worry about the economic impact of this.
Yeah. No, absolutely. I mean, I think that
doing at 10 a.m. Boris. Should you be watching this?
No. That's I know. That's why I was saying. I was trying to understand the mechanics. I was trying to confirm it with you.
Yeah.
That's that's the whole point. I was saying.
What kind of news turns this around? Obviously, with this huge drop in the 10-year yield.
What kind of news pushes yields back up? I'm trying to
exactly.
Maybe really hot non-farm payrolls, which is doubtful given all the data set that here. It really the economic data is starting to reflect clear friction in the economy. It may be a pause that refreshes, but if the pressure from oil is really like just absolutely the most important commodity in the world from that perspective. We've had this very benign cycle where we went from 110 to down to 160. And as you can see, it doesn't matter what the economy does, doesn't matter what the Fed does, doesn't matter what anybody, jobs grow. The moment oil goes from 60 to like 90, I can't, under most circumstances, imagine us not going into at least a mild recession as a result of it.
Wow.
At this point. So,
Julian, this is this is Q2, right? And so everyone's talking about what are the major themes for the second quarter. And one of the major themes for the second quarter is going to be, global deceleration and growth. And we're going to see that in the economic data. We're already seeing it, but I think it's going to be a much more consistent trend. And you're going to see more economic damage, as a result of, high commodity prices, especially if oil stays at $80 a barrel. You're going to see, talk of, rapid rate hikes coming to end, which is already happening, but actually seeing those cycles completely end. Those are the things that we'll be focusing on in Q2 and things that we'll be thinking about over the next few months.
Okay. Good to know. Now we're obviously moving into holidays, right? Good Friday's obviously, upon us. Easter Sunday. What does that mean for the traders who are viewing, today? Do we trade differently? Do we, have bigger stop losses, tighter, like the in and out? Is the technique exactly the same? Let's dive into that a little bit.
So, that's a fantastic question because, non-farm payrolls is released this Friday, which is Good Friday. So European markets are closed. U.S. bond and equity markets are closed. So with those markets closed, typically you don't really expect a big move off of the non-farm payrolls report. And, it is unusual for non-farm payrolls to be released on Good Friday. The last time this happened, but it does happen. Last time this happened was in 2021. And I want to show you this chart. I put together a couple of charts for today, but I'm going to share a different screen. So hold on one second. So I'm going to stop this screen. I'm going to share my top window. Here we go. So you should see, I'm just waiting for the chart to load, but what you should see is my dollar yen chart here. And the numbers are really small, but I'll read them out to you. In 2021, which was when the last time we had non-farm payrolls released on Good Friday, we had a blowout number, 916,000, almost a million, against a 604,000 forecast. If you think there's a big surprise, there's no bigger surprise than 300,000 pretty much, right? And guess what happened? Look, Dollar yen moved only 20 pips, right? Barely any move that day. And then euro dollar that same day moved its range high low was only 37 pips. So it tells you from this perspective that even when you have a blowout number, um, the Good Friday impact is significant in that it leads to almost no movement in the currency market. Now, of course, there are previous cases like in 2015. That was the last time we had non-farm payrolls on Good Friday before 2021. So that's basically a 6-year gap. So it is really rare, Julian, this happens. That time we had a pretty terrible NFP report, 126,000 against 244,000. And we did have a wider range. It was 110 pip range in dollar yen that day. In euro dollar, we had also a wider range, 75 pips, but not as wide as dollar yen. So, we've got two type of examples here, which tell us two very different stories, which, basically is technicals. And you can interpret things any way you want. But
Right.
the real difference here is that in 2021, the Fed was very transparent. Everyone knew what they were doing. They were very clear on, their path. In 2015, this was a bigger surprise. The market was kind of, uncertain about what the Fed is doing. And that's closer to the environment we live in right now. It's closer to the current situation where the market is divided on, whether we're going to get that 25 or not. It's divided on how much pain this OPEC move and this higher oil price is going to have on the U.S. economy. Now, our best advice is, first of all, if you're going to trade something, it should be dollar yen and not euro dollar, because clearly dollar yen has the bigger move than euro dollar because European markets are closed. But, who knows? It's best just to stand down. There's plenty of trading opportunities throughout the course of the day, throughout the course of the week. It's very important I always like to say, it's very important to know when not to trade. Just as you focus on when to trade. And this is, we don't trade non-farm ahead of non-farm payrolls as a rule, with my team. And, we don't trade on holidays. So when you've got non-farm payrolls and you have a holiday in the same day, just stay out. Go enjoy your Good Friday. Go have a coffee. Go to brunch with your family. Don't sit in the front of your screen and trade.
Boris, how about yourself? Are you gonna be trading during NFP, or are you staying out?
No. I actually, I'm gonna pretty much stop trading probably around Thursday morning, and next week, both Kathy and I are gonna be away. I'll probably, we're only like a Tuesday through Thursday, very, very light U.S. session. I think these next 2 weeks are, as I said, very treacherous. And if you are going to trade small. Like Kathy said, there'll be plenty of opportunities when we come back. The rule of thumb is, as a trader, you're like a surfer on waves, right? And if it's dead calm water, like everybody who goes, "Oh, I hate flat markets." Well, yeah, you hate flat markets because there is no liquidity, right? It's just it's a completely absent pool of water, and so therefore you don't trade. So I think it's worthwhile to just be much more cautious. There may be there are instruments that I think are responding, like you said. Gold is definitely responding. So it's a matter of, there's two things. It's a matter of knowing what not to trade, and also finding things that are moving that that could definitely be tradable. Like Kathy's trading dollar CAD. That's definitely a highlight story, and it will be a story for the next couple of days. So it's a matter of both, just finding the right instruments. And also staying away from everything else that we generally trade.
Right. I mean, we aren't around next week, but this week and next week is going to be very, very important in setting the stage for the next Fed meeting, because we have non-farm payrolls on Friday. Next week, we have U.S. inflation data and we have U.S. retail sales data. And so, all of that is going to be extraordinarily important in setting, to helping investors and traders position for what they think the Fed will do. So that's why, it's going to be treacherous, because, of the importance of each of these pieces of data.
Right. Boris, any charts you want to pull up? Any assets or anything like that?
Boris, people are asking about gold. Do you want to talk about gold? I have some people asking on my Twitter Spaces.
Okay, let's look. Let me pull up gold here for a second, and then I'll share my charts. It's looking bullish. That's all I got to say. Hang on, share screen. Gold. Okay, so this is the. I think this is the hourly chart. I'm on the hourly chart right now.
Can you zoom in?
Yeah. Just I was zooming out because I wanted to just give you like a broader contextual idea. So this is the peak, the 2000 peak, where the twin peaks, the double peaks that we talked about here, right? As you can see here, gold is really making today is a very bullish day for gold. I mean, it's had like 5-6 straight hours of pretty much straight up buying here, and I think that's a function also of I was reading somebody I was listening to on the weekend on the podcast said it's almost impossible to figure out what moves gold on a long-term basis, but the one variable that seems to forecast it really well is real interest rates, right? And so if real interest rates go down, that means inflation goes up, but the Fed feels like they have to cap their hikes because the country is in a recession, right? That's the sort of 1970s scenario. 1970s scenario was really, really high nominal rates, but really, really high inflation, but relatively low nominal rates because the Fed couldn't raise rates, in perpetuity, and that created a very, very positive structure for gold.
Okay.
And so, I think we're all watching that 2000 level. I do think it's one of those kind of things where three makes a charm. If we take it out and hold it, we talked about this idea. It doesn't have to. It's not that you just got to take it out. Got to hold it for a day or two, because once people get comfortable with the idea, oh, gold is now 2000, nobody's selling it, then they're going to come back and buy it. I think that's one of the more interesting things I learned from much more seasoned technicians who trade. It's not necessarily the break at a level; it's the hold at a level that's then much more effective in determining how you want to structure the trades going forward. Yeah.
Okay. Interesting.
Yeah.
Now, I know everybody wants to know what about Bitcoin? We got a breakdown on Bitcoin there. We think this thing continues to push on up. I've actually have not looked at it today.
Yeah. So Bit is even less predictable than gold in a sense, because it doesn't have any history of thousands of years of being held as a store of value. Bit is very much, I still think, an experimental asset. Oh, I like that. I just came up with that idea. It's an experimental asset, meaning that nobody really knows if it has any value. But I will say this. This is from somebody who thinks that all crypto is nonsense. I will say this. It has survived everything that's been thrown at it, right? It has certainly made, if we look at Bitcoin, let's just go look at Bitcoin on a much longer term basis, because I think
Bitcoin is actually the best performing asset in Q1.
Yes,
so it's the best performing.
Right, but what my point here is even much more longer term. Let's go to a monthly chart, right? So when you look at the monthly chart, we talked about this on Friday. I think it keeps making higher lows. That is the very definition of an uptrend. That is the very definition of a attractive asset, right? It's not the higher highs, it's the higher lows. It's how far it goes down before people make a bid, meaning that they're finding value in the thing. And I will say one sort of theoretical support for Bitcoin and almost all of crypto is decentralization. One of the things that I keep listening to a lot of macro analysts talk about is that how we got ourselves into a terrible, terrible, terrible economic pickle by essentially relying on one central point of supply, which is China and production, right? and how the whole supply chain and if you look at everything in the world, there's one Amazon, there's one Tyson's Food, there's one, there's like 2 or 3 oil majors. Like almost every particular good in our economy is controlled by 1 or 2 big players. And therefore, we all know that if you have one point of control, you have the most vulnerable point of failure, right? Because if that major thing goes down, everything else fails around it. And the whole premise of crypto is that you don't have one point of control. It's as distributed as the internet, right?
Yeah.
To that extent, I could actually theoretically, see the value of Bitcoin. Bitcoin is proving in some ways that very same notion. Now it's still, ridiculously volatile, and it's still, I don't think it's kind of priceable in any kind of a reasonable way, but you could make this argument that this is a asset that is distributed and therefore much, much more robust than every other asset, which is essentially centralized by 1 or 2 big parties, right? And that's an interesting, change of thought on my perspective on Bitcoin. So, but from a near point of view, it's a buy. Like Kay said, it's a good looking buy. It's on a monthly, it's in my buy zone. I mean, we can't put this on a monthly on the zip, but we can put this on an hourly on the zip, and let's see what that does. Let's see what Kay has to say about this. Let me just put the zip on here. I have like 1,000 indicators now. So, oh my God.
Well, we actually use Crypto Crusher for Bitcoin, and our BK Crypto Crusher. And in the long term, we've had a nice buy signal in Bitcoin in our setup. Now, this is a short term. I don't really, to be honest, I don't use Zip. You have to know when to use your indicators. I don't use Zip for Bitcoin because it's not.
It's so volatile.
Yeah, it's too volatile. It doesn't. It's been.
You can totally see that. It's just choppy as hell. I'll have to code Crypto Crusher now onto TradingView for you, and we'll be able to put it down. Because I'm now, with the help of ChatGPT, I'm now a minted coder. Right?
There you go.
Created a whole bunch of stuff. I'm actually like, let's just do one more fun thing. Let's see if I can put which one of my things that I want, the tidal wave. Let's see if it's showing anything on the tidal wave on this thing. Let's see if it's gonna. Oh my God, this thing is gonna crush. No, I put it on a monthly. It's gonna. Oh no. No. Okay, no, it's fine. Actually, let's do one more thing. Maybe we can put it onto perfect order for Kathy. She can see if that's working. Okay. So it has a perfect order by a couple of hours ago, but it did dip around. So far, it hasn't produced a perfect alignment of all the moving averages to go to the top side recently. But it definitely looks. I think it still looks choppy on a very short term basis, right? It still looks very, very choppy on a short term basis, but definitely with higher lows. Just forget all indicators, just pure price action. As long as it kind of holds this 2750, you got to be a buyer. That's the bottom line on Bitcoin. We don't need to get any fancy indicators. We can just look at naked charts and see what's happening.
Okay, very good. Now, Kathy, I want to ask you, about the Bank of New Zealand, U.S. banks, exit strategies for trades, that kind of stuff. Let's dive into that just a bit.
Yeah, we have a bunch of questions on Twitter Spaces, so we'll just go through them. The first question is, what about the RBNZ rate hike this week? Is it happening? What kind of impact it's going to have on the loonie? I posted on Twitter earlier this morning that we were long Kiwi, and it became a really beautiful trade because, it's really simple. Everyone's been talking about an RBNZ rate hike. They've been talking about how RBNZ has been talking about how they want to do 25 basis points. So it's happening this week. It's one of the very few event risk. They're one of the fewer central banks still, maintaining a relatively hawkish bias. So if you zoom in, you need to zoom in more, Boris.
Yeah. I will zoom in, but it's definitely gave a very strong signal.
Yeah, we took the first buy signal that happened at 6 a.m. You can see it was a power move higher in this chart in Kiwi dollar. So RBNZ is raising interest rates. I would be long going into RBNZ. However, with that said, It's not clear what their guidance is going to be, whether they're going to continue to pound the table on more or whether they're going to start to dial back. So I would be out afterwards and then see what they say and then ride that move afterwards. In
How
terms,
you like the size of that arrow? Is that good enough for you, Kathy?
I love it when it's big.
Okay.
So
Next question.
Strategy. Like on a trade like this, basically the best thing to do, first of all, it is very clear and obvious that you should have been out at that previous swing high.
Yeah.
Boris and I are huge on swing highs. And if you look at this chart, that previous swing high is pretty much exactly where today's,
Right
yeah,
there.
we're in, your Twin Peaks, right?
Yeah.
That's pretty much exactly where Kiwi dollar stopped today. And that's why these swing high, swing lows are so important with trading. So one of the most important things with exit strategies, first of all, you should know approximately where you want to get out, right? Like, well, this is a day trade, so maybe 30, 40 pips. But, you can't ignore what's happening. You can't ignore key levels either. You see this huge level, regardless of how many pips you got to start to wind down some of your positions at those levels. So when it comes to exit strategy, part of it is your risk management and your standard stop and loss. Part of it should be just look at the chart and look for yourself what's happening. And that it has struggled there, just like 2000 is a key level in gold.
Yeah,
That's struggling there.
This is something that we talk about all the time. It's really worth just sort of examining for just a little bit. And those of you who are on Twitter Spaces, come onto YouTube. You can really see it. We always talk about the idea of round numbers. In FX, in more than in any other asset, round numbers matter. And this is a 63 level. Look, it just dies. There's a lot of reasons for it. I mean, I can give you a couple that are just market dynamic reasons. In FX, you have a huge amount of knockout options. These are options that basically knock a person in or knock a person out at key levels. And most institutional players are like everybody else. They like round numbers. So there's probably a lot of options at 63. And this thing started to spike. And the guy probably has 500 million expiring at it. And he's like, I'm going to spend 50 million driving this thing down because I don't want this thing to hit against me and put me out of the money on this particular option. Remember, most of these contracts are time sensitive and price sensitive. They're kind of digital. They're like, it's good until like 12 p.m. today. So if I could just hold off these guys till 12 p.m. today, boom, I've collected my money on my options. So there's like a lot of gamesmanship that goes on, which is why the round numbers are so important. And if you understand it about FX, it really helps you exit your trades. This is exactly what Kay was talking about. It really helps you time your exits much more intelligently. Sometimes they're going to barrel through. Sometimes all your logic may be completely upended if the news is big enough or if the demand is big enough, which by the way brings me to the other point, which is that the one key thing that you want to do with risk control is if you are super bullish Kiwi, you give up like half, go to break even, let the other half go, or give up 2/3, hold 1/3 or 1/4 for that runner and let that go. That's a strategy Kathy uses quite a lot in her trading. Very, very effective because you take the highest probability exit, and then if you get lucky, you manage the rest of it, for maybe a couple of bars higher.
And just to reinforce that point even more, look at the bottom of this chart. Look at where this move stopped. Pretty much the same level as the one to the left of it.
Oh yeah, right here. Yeah.
And so it just reinforces, trading. Don't need to make trading complicated.
Yeah.
If you just focus on swing lows, swing highs, oftentimes that's good enough.
Right.
So Boris,
you're looking for buys and sells. Just out of curiosity, and I'll ask the both of you: are you guys looking to take it? Maybe it's a case by case basis, but for the traders out there who are newer, are you taking it to like you said, the highs? You're obviously looking at price action, but it's more like I tell our Discord as well. It's more of like a zone. It's more of an art than it is. Hey, it needs to hit this number exactly.
100%. It's never an exact figure. Anybody and I love all these guys on YouTube go, I'm going to buy Aussie at 69.8. It's the perfect 68 point retracement of Fibbo. Good luck. Come on, please. Yeah, it's always a zone, and if you're in an intraday basis, it's always at least a 20 to 30 point zone at minimum, just in terms of breathing room, because they're going to run. You don't think they know that a lot of times what you'll see is they'll run the stops and then bring it right back up for like 10, 15 points because they know that everybody is trying to come in at that level, and they're trying to scare people out. It's a game of poker. You got to know how to play it, and like with everything else, you need to have the position of strength, and position of strength means that you have to give yourself more room for wiggle room.
Yeah,
Um,
100%.
right. Okay. I think I interrupted you. You were asking me something before.
Well, I was going to throw this next question at you. How worried are you guys about countries bypassing the dollar, and can you see the dollar completely collapsing?
No, no, and no, and no, and no. Like name me another country where you have a rule of law, you have the deepest capital markets in the world, and you pretty much buy. I mean, the Chinese can walk into America, buy whatever the hell they want, make money, and leave. Right? Pretty much. Right? Name me what American can walk into China, buy anything he wants, make money, and leave. Until we get to that point. I'm going to hold my. I'm not going to hold my breath about Russia and China and Brazil. Countries that are not exactly the places you want to run to when things go bad. Holding all your money. Who's serious? No serious investor is going to abandon the dollar under this pretext. Okay, so that's my answer to that. The closest
we were talking a little bit about that off cam, that with these, countries coming together, that will it weaken the U.S. dollar? Is this why people are kind of fleeing to gold or fleeing to Bitcoin because they're uncertain?
If anything, Bitcoin certainly has the ear of that decentralized, sympathetic, flight and diversification dial. Gold, as I said, is trading very much on real yields right now. Listen. Oil goes up, gold goes up. It's just that's the way it works, baby. Right. Because when oil goes up means real rates go down, and that's the cycle. There's nothing complicated about it. Also, so don't try to conspiracy theories explain nothing. It's much more basic, and all of it will, and you'll forget all the talk of the dollar will stop the moment oil goes down, and we basically regain our footing again. Okay. So far the only competitor to the dollar in terms of safety, rule of law, and civilization is the euro, and it's what 35% diversification. It's really not it's definitely a good asset, but it's not been a true competitor to the dollar in terms of liquidity and depth of markets. The other thing that people don't understand is where are you going to sell $1 trillion worth of treasury bills? Are you going to go into the Chinese market, sell $1 trillion worth of Chinese treasury bills because you need to get liquid really fast? You're going to sell $1 billion of Chinese treasury bills? Good luck. The Chinese government is going to just laugh at you. What people don't understand when they talk about the dollar standard is just how much institutional protection there is in the U.S. markets or in the Western markets for everybody, not just for the special few. And in all these other countries, it's just a protection for the special few, and that's why it's never going to work. So having come from Russia and having lived in a authoritarian regime, I laugh every time somebody tells me the dollar is losing the standard. You really don't understand these countries. Nobody's running to go to immigrate to China or to Russia right now. They're all running to come to us. So until that happens, the dollar isn't going anywhere.
I got you. Well, I know we wanted to transition a little bit into, trading psychology, just kind of wrap it up a little bit. Boris, I know you wanted to talk on, ways you win, ways you lose.
Yeah. So, and I'll make it very simple. We can talk more about this when we come back, because this is a kind of a long conversation. So I don't want to get, because I kind of started talking about it with my BK guys, and we got so into the weeds that I was like, okay, I think this is, we'll keep it high level.
Brief,
So basically, what you need to think about, and I'll give a very simple example, and we can do a lot more. And you guys, by the way, on Twitter Spaces, feel free to ask us next time we come back. We'd love to discuss this, because this is, in my opinion, the single most important formula that almost nobody really thinks through, including yours truly, thinks through really, really honestly until it kind of hits them in the face, and and they feel the pain of it. It's basically the value of R. R stands for both risk and reward, right? And R is kind of an abstract value. So R, if it's a reward, let's say you're trading for $100 profits. It doesn't matter what size, it's what the stop is, what the size of thing is. You're just making it everything equal to a $100 trade. So $100 trade in Bitcoin may be a tenth of a tenth of a tenth of a Bitcoin, and a $100 trade in Aussie could be a tenth of a lot. But it's just a simple example, right? The question is, you can think of it as what is your break-even rate and what is your P&L rate. So in a classic example, you have a 2-to-1 risk-reward ratio. You're gonna risk $100 to make $200, right? That's your P&L. If you are at 40% accuracy, right, that means you're going to win 20 R's. And remember, that R can be $1 or it can be $1,000 or it can be, $100, whatever it is. But your net R, your net P&L per 100 trades will be 20 R's, right? Mm-hmm. And that's like in a very positively skewed risk reward. What if you're trading in a negative skewed risk reward ratio? Let's say you're trading in a ridiculously negative skewed risk where it's negative 15 R's for every R. Let's say you're trading a strategy that makes you R every hour on the hour, but when it loses 15 R's, right? Well, if it loses 15 R's every 50 times you trade, right? Every 50 times you trade, then you're net positive 35 R's. And on a 100-time basis, you're actually going to make 70 R's, right? So that's actually a very positive strategy if those are the numbers. But you need to be very honest with yourself. You need to gather the data. And of course, the big problem, I think, is if you're trading super fast like we do and you're generating 20, 30, 40, 50 trades a day, you can see that within a couple of weeks, you can see the data set. You can say, oh my God, this R is horrible. Or we're trading US 30 and we call it the problem child. I mean, that thing is it just nearly wiped me out, while we were talking. I just literally got lucky on my literally last trade here. And I basically survived it. So that's an instrument that's really, really very difficult. Ironically enough, the NASDAQ has been like a stalwart. Like we haven't had a single negative R come out of NASDAQ in like 50, 60 tries. So when you build up a database of trades, and, Kathy does this all the time. I mean, she trades, I don't know, you trade about 10, 20 trades a day? I don't even know how many trades a day, but you've definitely built your R pretty well. And when you know your R pretty well and you know that your R is net positive, then you can say, okay, first of all, you stop worrying about a single trade. You stop worrying even the next 10 trades because you want to think about in 100 trade batches. In this particular strategy, I have an expectancy of making 20 R's per 100 trades. As long as I'm somewhere close to that, I mean, if at the end of the day I'm coming down and I'm making negative 50 R's, well, either the market has changed or the strategy is no longer working, or I need to adapt. But until that happens, you need to just simply stick with your strategy and analyze it. But what most people do is they go on a trade by trade basis, and therefore they don't have any sense of comparison. They don't have any sense of metrics. It's like making a different donut every day. You're never going to know how many donuts you're going to sell. They got to be all the same. Just like McDonald's doesn't make a different hamburger every time they put it out. You got to be the same way as a trader. That was my thought. Yeah. So know your R's. That was just like know your arithmetic, know your writing, know your R's.
Yeah, exactly. Kathy, anything you'd like to add to that?
No, I think it's absolutely true. I mean, I have done, I would say, tens of thousands of zip trades. And in those tens of thousands of zip trades comes the confidence to keep trading on good days, bad days, good weeks, bad weeks. You really have to know knowing your R is really, in a simpler term, knowing your trading strategy. And, that comes from making sure that you trade it consistently, making sure you follow your trading rules, and making sure that you do as much as possible to make every next trade as as correct as possible, and make sure you don't deviate so that you're only adding value to your strategy and adding information to your results, and not trading haphazardly.
That's actually super good point. See, I don't have any discipline to do that, so I have my algo do it. Kathy actually, but that is a very, very good point, that in order to actually truly measure the quality of your strategy, every trade needs to follow a process, right? Yeah. And you need to follow your process on every trade. Otherwise, you're comparing apples and oranges. Let's see how many useless cliches I can come up with today. Between know your R's and apples and oranges and everything else.
I mean, I think we might have talked about this, prior, or maybe I was speaking to, another trader, but, the analogy that I got was almost the worst thing that a new trader, or even an experienced trader can have is something that's off of their trading plan that works. Because then all of a sudden, like you said, you want to take it and you deviate off of what you typically would do. and you go, okay, I'm going to start implementing this into my trading plan. You've got no data, no arithmetic, so getting into that. And
I'll take the opposite of that for just 1 second, because and Kate will laugh, because this is what I do all the time.
Yeah.
It's absolutely true that you don't want to do that as a like you don't want to commit to a completely different strategy right off the bat. On the other hand, if you find something unique and interesting that worked once and worked twice, that you've never done before, it is very, very, very valuable to run that at incredibly small size for lots and lots of trades, because sometimes there will be some of the better ideas you'll have. If you're constantly, the thing about the markets is they're constantly evolving, and you have to be very, very adaptable to new ideas. But it's how it's understanding that this isn't nirvana right away. It's just an interesting idea, and I want to test it for quite a long time. And usually what happens is, by the end of that process, the original idea that you had is 1,000 times different from what it was. But if it works, it tends to be very robust version of what you're doing.
I think that basically encapsulates how different Boris and I am. He is like the king of experimentation. Every single week he's doing something different. Every single week he's using new technology to try to make his process better. Every single week he's looking at trades a different way. I, on the other hand, have been doing the same thing for years. It works. I'm happy with it. And I'm just sticking with it because, through many market environments, it has proven to me that it's effective. And, I don't have to guess, basically. It's, almost in some ways autopilot.
Yeah. Yeah. But ironically enough, she trades her stuff manually, and I trade all my stuff algorithmically. So
that's because my stuff incorporates fundamentals and things that like yields and stocks and multi-market analysis. It's very difficult to code.
Right.
Well, I think that the good news is for traders that are viewing this is, it's not a cookie cut system. One size is not necessarily fit all, but that's a good thing, right? There's a lot of flexibility in this market. Like you guys always say, there's a way you can make money in any ways. You're going long, you're going short, that kind of deal. So that, I think, it should be the encouraging word that people grab, but with the right head on your shoulders, like you said, Boris, in your case, you're experimenting, you're doing different things, with the proper data points, with the smaller size, gathering, your data that you need, saying, okay, I can add this kind of to the arsenal is definitely something that can be positive as well.
100%. 100%. Is there any more questions, Kate, on Twitter? Or
no, that's pretty much the questions that I see.
Okay. Got it. Okay. Sounds good.
Excellent.
Well, this was
guys,
a lot
thank
of fun.
you so much for doing this. Yeah, it's always great, obviously, seeing you guys on Monday. And then obviously we talk about what news is getting ready to come out. Obviously we will miss you guys. You guys have a safe trip. But obviously when you return, we will talk about all things news. We'll go through our therapy. We'll have a lot of, juiciness to talk about. And, like you said, just see what these next news, reports kind of set us up, like you said, Kathy, for the Fed and that kind of stuff. So
you got it.
Sounds great. Thank you all.
Thanks, Ian. Everybody have a great time.
Have a good one.
See you.